As the U.S. markets are currently closed for the weekend, we are looking at the final print for Pfizer, ticker PFE, from Friday, November 7, 2025. The stock closed the session at $24.435 per share, ticking up just slightly by about 0.06%. But that flat, quiet price point is deeply misleading. The real story, the one that should have every single person watching this stock on high alert, is the volume. Over 117 million shares changed hands on Friday. That is an absolutely massive figure, dramatically higher than its average. This isn't quiet, end-of-week profit-taking. This is a battlefield. This is a level of trading activity that signals a profound disagreement among the largest institutions in the world. While retail traders on platforms like Robinhood or SoFi Invest might be looking at the 7% dividend yield, the big money is making billion-dollar bets on whether Pfizer is the single greatest value play on the market or a catastrophic value trap. The common belief, the narrative you'll hear everywhere, is that Pfizer is a broken company. It's the COVID stock that had its one glorious moment in the sun and is now paying the price. The expectation is simple: declining revenues as Comirnaty and Paxlovid sales fall off a cliff, a patent cliff on other key drugs that threatens the balance sheet, and a dividend that looks increasingly unsustainable. People look at their individual brokerage accounts, see PFE sitting deep in the red from its 2021 highs, and assume the story is over. They see it as a relic, a high-yield trap, and would rather put new capital into something that's obviously working, like Nvidia stock or Apple stock. The expectation, in short, is that Pfizer is yesterday's news, a slow-motion collapse that isn't even worth the high dividend. But the reality of what's happening under the hood is something else entirely. The reality is that the 117 million share volume spike isn't just panic, it's a massive repositioning. The Q3 2025 earnings report, which dropped just days ago on November 4, wasn't the disaster everyone was bracing for. In fact, it was the opposite. The expectation was a huge earnings miss and a guidance cut. The reality? Pfizer beat on earnings per share, posting adjusted EPS of 87 cents, and it didn't just maintain its full-year guidance, it raised and narrowed its adjusted EPS forecast to between $3 and $3.15. This is the tension. The market is pricing in a collapse, but the company's own financials are signaling stabilization. The most critical number in that entire report wasn't about COVID. It was the 4% operational revenue growth from Pfizer's non-COVID portfolio. This is the entire thesis. The patient is no longer bleeding out from the COVID hangover. The core business, the real Pfizer, is actually growing. This changes the entire calculation. It means that while the market has been obsessed with the past, management has been executing a brutal, necessary, and high-stakes pivot. This isn't the Pfizer of 2020. This is a company in the middle of a painful transformation, and it's betting its entire future on one thing: cancer. The $43 billion all-cash acquisition of Seagen, which closed at the very end of 2023, was not a minor addition. It was a bet-the-company move. Pfizer essentially bought the world's leading platform in antibody-drug conjugates, or ADCs, which are one of the most promising areas of oncology. They are like guided missiles for cancer cells. This single move doubled Pfizer's oncology pipeline, and they are just now beginning to integrate it. The expectation is that Pfizer is a vaccine company. The reality is that Pfizer is desperately trying to become the world's leading oncology company, and it used its COVID windfall to fund that transformation. So let's look at the recent trading. The stock is still wallowing near its 52-week low of $20.91, At $24, it's closer to the bottom than its high of $27.69. This is the definition of a depressed asset. The massive volume on Friday, following those solid earnings, suggests that some institutions are throwing in the towel. They are the expectation crowd, the ones who wanted a simple, clean story and are tired of waiting. They are selling. But on the other side, you have buyers absorbing all 117 million of those shares. Who? The reality crowd. These are the funds looking at the Q3 numbers, looking at the raised guidance, and looking at the second part of Pfizer's plan, the massive, aggressive cost-cutting. This is the part of the story that Fidelity or Schwab Intelligent Portfolios might focus on for their long-term models. Pfizer isn't just betting on Seagen, it's protecting its dividend with an iron-fisted cost realignment program. The company is on track to deliver a staggering $7.2 billion in net cost savings by the end of 2027. They already achieved $4 billion in 2024 and are targeting another $500 million in 2025 from the initial program. On top of that, a new manufacturing optimization program is designed to pull another $1.5 billion in savings by 2027. This is the lever that management is pulling to protect its operating margins and, most importantly, protect the dividend. When you have a 7% yield, the biggest question from any serious investor is it safe? Pfizer's management is screaming that it is, and they're showing their work. They are funding the dividend not just from earnings, but by making the entire organization leaner. This is the part of the story that many are missing. They see the high yield as a warning sign, but the reality is that the company is undergoing major financial re-engineering to defend it. Of course, this is a pharmaceutical company. It lives and dies by its pipeline. This is where the Seagen bet has to pay off. Pfizer now has 13 phase 3 trial starts and 8 major late-stage readouts expected in 2025 alone. This is an incredible amount of activity. They are moving fast on the assets they acquired. For example, a drug partnered with 3SB, PF0864404, is now being pushed into pivotal phase 3 trials for both lung and colorectal cancer. But the even bigger story, the one that could truly rival the growth of a Tesla stock if it hits, is the obesity market. Pfizer famously failed in its first attempt at a GLP-1 drug, which hammered the stock, but they didn't give up. They went out and acquired Metsera, giving them a new, credible, and potentially best-in-class set of GLP-1 candidates. So now, Pfizer is not just an oncology play, it's a stealth GLP-1 play too. It's a second high-stakes lottery on top of its primary oncology bet. This brings us to institutional sentiment. The consensus analyst rating is a hold. This is the definition of "we don't know." Fintel data shows over 3,800 institutional owners, but the recent trend has been slightly negative, with a small decrease in owners and a 5% drop in average portfolio allocation. The big funds are nervous. But the 13F filings from this past week, the first week of November, tell a fascinating story of that 117 million share volume battle. On one side, you have firms like New York Life trimming their positions. On the other, you have Oppenheimer and Madison Asset Management adding. But the biggest headline, one that many self-investing traders using platforms like Interactive Brokers are pointing to, is that Scion Asset Management, run by Michael Burry, revealed a massive call option position in PFE equivalent to 6 million shares. This is one of the market's most famous contrarians, placing an enormous bet that the reality, a successful turnaround, will win out over the expectation, a slow-motion collapse. So what does this company actually do? For decades, Pfizer was the blue-chip biopharma giant. It brought the world blockbusters like Lipitor, Viagra, and Zoloft. It's a massive, global organization built on discovery, development, and manufacturing of medicines and vaccines. Its business is now split into key therapeutic areas: oncology, vaccines beyond COVID, internal medicine, and inflammation. The problem, and the source of the stock's pain, was the post-pandemic cliff. The world stopped getting boosters at the same rate, and Paxlovid demand fell dramatically, and it did. This created the value trap narrative, but that narrative ignored the $43 billion Seagen bet and the aggressive cost-cutting. As we look forward, the path for Pfizer is built on this tension. The future outlook is a clear two-path scenario.